Hello, welcome to Woodybrando's Wild Ride, episode number 2. So I've made a couple episodes in the in-between, but with the way the markets move so fast and me being in the middle of a move to Prague, by the time I would sit down to edit it, what I had even said was out of date. So I did that a couple times before realizing, okay, let me just wait till I get to Prague and then I'll have some time to do this. And also the other thing is that because I didn't do a great job, I guess, explaining my strategy in the first video, I had some friends that just like bought all in at a single price. Now granted, they got lucky and the price doubled almost within 3 days and ended up making money, but that's not why I'm making these videos, for people to just buy at a single price. The idea is to kind of have a hedge strategy so you can get in with a small amount of money, sort of learn the market, understand what momentum there is in the market, understand what prices the market kind of likes and the range and everything, and then be able to have this sort of hedge strategy to protect you no matter which way the market goes. So that made me think, okay, let me put this on hold for a second and go back to coding. And so I did. So as you can see here, the code is alive and running. Eden is living in both GDAX and in WEX. My wife has a version that she wrote for WEX. It's a different sort of logic path than the one I wrote for GDAX, but both are running and working right now. They're both in alpha stage, so we're not releasing them to everybody. You would have to kind of know Python and know the crypto markets enough to know how to navigate them without any fear. So what we're looking for now is people who are ready to test this and help us sort of figure out all the use cases so that we can start working together and making sure it's pretty bulletproof before we give it a wider release. And I figured that was important because as much as I try to explain this strategy, it's going to be potentially misinterpreted. And I'm a sensitive person. I don't want to go through the world just giving half understood advice to people so that they can potentially put their value at risk. So that being said, what I want to do today quickly, because I'm running low on battery, is just basically explain what I'm basically doing here in the software. So all right, so my battery died, so I didn't get to finish that first one. But since the CME, or whatever it's called, the shorting of Bitcoin, is going live tomorrow, and I think that is part of the reason the price has gone up so fast, so quickly, is that these companies that are looking to short Bitcoin, which means basically make a bet that they are going to be able to buy Bitcoin at a cheaper price in the future, but then that gives the moneyed people of the world, the people that have built this broken criminal financial infrastructure that we call central banking, the incentive to make the price of Bitcoin go down. And so that scares a lot of people to think like, oh my God, Bitcoin's never been this expensive, and now it's going to go potentially be pushed and suppressed down the way silver and gold has been manipulated through the paper markets. So, and yes, and this too, I keep hearing, and it's driving me crazy to hear all of these financial experts in suits and ties that have the nicest houses in everybody's towns telling people that volatility is just this big scary thing and to stay away from volatility. Actually, Richard Branson is one of the first people I've seen actually kind of cheekishly say
it is quite volatile, but you know, when in volatility, people can make money out of volatile situations.
But he doesn't explain how. So this strategy is how to make money off of volatility, but also, I think more importantly, it's just how to get the courage to go into a market that you're afraid to go into. And it gives you a way to, almost like a thermometer for a market, to put in a small amount of money to sort of get comfortable with the market, but then also kind of gauge where it's going, where the momentum is, and what a good price is. Things like that. So I wanted to just quickly be able to get something out fast before this Bitcoin shorting goes live tomorrow, so that if the market price does start to crash, people don't just sell and panic sell, that they have maybe a strategy to help them understand that a low price is a good thing. You know, when things go on sale at the market, you get excited. You know, if TVs go on sale for Black Friday, everybody gets excited. But if Bitcoin goes on sale because it drops half price, nobody gets excited. I mean, anyway. I think it's hard for you to see this, so I'm going to try to draw in bigger numbers. They're going to be sloppier looking, but hopefully easier to read from over there. Okay. So this is our potential market prices: $1, $2, $3, $4, $5, $6. And we're going to say that right now, the market price of this thing, whatever it is, we're trading cryptocurrencies, but this works in anything, any kind of market that's denominated in numbers. We're going to say the market price is $3. Our initial investment is going to be $20. So I'll put it over here, 20 bucks. So the idea of the strategy is to take a portion of your initial investment and then to buy it at market and then set your sell point as soon as you buy it. And so what we like to do is set the twice market as the sell. You know, if you can double that money, that's a pretty good investment. So we would take, for this example, I'm going to take a quarter of the initial investment, which is $5. So we're taking 1/4 of our initial investment. This $20 could be $1,000, it could be $20,000, but smaller numbers make it easier to understand the concept, so I'm using a very small number to do it. So we take our $5 out of our 20, and this leaves us with 15. So we would take this $5 and buy at market right now, which would get us 1 2/3 coins. So this goes spent at market. So that gets us 1.6 coins, and we put this at double market to set it up as a sell. All right, so that. So this is going to be our moon basket, or sometimes I call it the moon bucket. I'm going to call it the moon bucket right here. All right, there's our moon bucket from our initial investment, 1.66 coins. So now, with our other $15 of our 20, we're going to cut it in two. We're going to divide it in two. This is a division sign, divided in two. And that will give us two sets of $7.50. So we took our $15, cut it in half, and so that means half we're going to buy right now at market at $3, and that will get us 2.5 coins. So this $7.50 goes to market as well, the little piggy. All right, so this $7.50 goes to market too, and this is going to get us 2.5 coins at $3. The above is here. The above is what is between market and your moon basket. So we have two positions. We have $4 and $5, and we have 2.5 coins. So we just divide 2.5 by 2 because we have two positions, and that gives us 1.25 coins to put at each of these positions. So 1.25 are going to sell at 5, and 1.25 are going to sell at 4. So we bought these coins at $3, and we're going to sell these at 1.25 at 4, and we're going to sell another 1.25 at 5. With our other money, our $7.50, we are going to split up our $7.50 into our two positions below market. So below, we have $7.50. We're going to divide that by our two positions, and that gives us $3.25. This is a 325 buy, and a 325 buy. So that's basically it. That's the strategy. So you're taking $20 and you just have a pattern for it, or whatever the investment is. So you now have a pattern. And so what is happening here, I'm going to explain a few things. So what this is, I kind of call this each of these numbers, the peg. So this would become a $1 peg, a $2 peg, a $3 peg, a $4 peg, $5 peg, $6 peg. So the pegs that are below market are constant value because you're going to get more buying power as the price goes down. So you want to keep the value constant. So for instance, at $1, you're going to get 3.25 coins for $3.25. At $2, you're just going to get like 1.6 something coins. So the benefit to this is that you can get a little bit excited as the price goes down because you're like, oh wow, price is going down. I hope it goes to 1 so I can get 3 of these coins for $1, where I would have only gotten 1.08 coins or something if for that $3 at market. For your pegs between market and your moon bucket, you want a constant volume of coins because your volume is going to gain you more value as the price goes up. You know, you're buying at a set price here at $3, so you subdivide your volume equally among all your pegs between the market and the moon bucket. And then as the price goes up higher and higher towards your moon bucket, you're getting more value because the volume is constant and the price is going up. Here you're getting more value because the value is staying the same, but the buying price is going down, so you're getting more volume for the same value. Okay, so now this is basically what I call like a investment appliance. You're not trying to get your $20 back. You're just trying to let your $20 sit there as long as the market lives between $1 and $6. And as it moves up and down in this range, you're making money off of the retraces. So for our example, we're gonna have the market move from $3 to $4. We trigger the sell, and that's gonna give us, so 1 times 4 is 4 1/4, so 5. So this is gonna give us $5 when this triggers. So now we move this $5 trigger down to our $3 peg because the market has now moved up. So I can erase this because now this is where market is. And now we have $5 at the $3 peg. And this is a buy. Okay, so after it's moved up to 4, now the market comes back down to 3. Let's see what happens. Now we have $5 as the market moves down. That's gonna buy us 1 2/3 coin, or 1.66 coins, which get put back at the 4. This is basically the value of the strategy, or this is the magic of the strategy, is that someone that's just long holding isn't having any increase in value with the volatility. And so when these financial experts go on television, they say Bitcoin is so volatile, just stay away. They're not telling you that there's ways to make money off volatility. And in fact, you want volatility because it's probably the surest way to make money off of markets. You can't know if the market's going to go up or down, especially since so many markets are manipulated. But you know it's going to go up and down. So if you can cover the range and set up your strategy so that you're always putting yourself in a position to make a percentage of gains ultimately over the retraces, then you want a volatile market. Bitcoin is like a perfect place to put a strategy like this in place. And so let's say the market goes down now, just to continue our example here. So now let's say the market goes down to 2. So now we're gonna have the market go down to 2. We're gonna buy 1.625 coins. And so yeah, so then we'll take our 1.625 that we just bought, and this is a sell. I can get rid of this arrow now because that's actually not the market anymore. And this is a sell. Now the market lives at 2. So this is basically the strategy. You just let the market treat the market as like free energy, and you're just putting like a free energy machine on top of the market and letting the retraces be the free energy that you get in the form of coins or cash. And so if the market goes below here, like in reality, you're not just going to have 2 pegs here. You're probably going to have like 30 pegs below market, and it's going to be to a quarter of your current market price. So you're protected down. So say the market price like of Litecoin now is 150. You could have the pegs go all the way down to $50 and spreads of $10, and all the way up to $300 and spreads of $10. And you're getting enough volatility because the price has just reached 150 that you are having $10 retraces. And if you have any significant volume, you're going to make a good portion of money over a retrace. On a retrace. If you really cover a nice percentage of the range based off of the current market price, you're going to get it living in there for a long time. And as it's living in there, you can kind of get, you can tell, is it moving up out of your matrix or is it moving down out of your matrix? And as it's making these moves, you can start building in more squares below, as I've done with the NEM coin. NEM coin used to be 0.0001 to Bitcoin, and then it went down to 0.000009. But because I was trading in a matrix and I was seeing it slowly compress down against Bitcoin, I was using my retrace profits and filling out below. So it hit all the way at the bottom of my matrix, and then it finally turned back, and it almost doubled the money eventually, because it's like a self-generating investment system, I guess. But the thing is, like, if you do, say you're up at 5 and you're making good volatility up here and you're getting a lot of retraces between 4 and 5, and you start using that money to build out your bottom, or the other way around, if you're living down here between 1 and 2, and you've already filled out your below position, with all the volatility between here, you can start using these retraces to start filling up above and move your moon bucket up, because now you're getting whole coins every retrace, because a coin is only $1, so you're going up $1, so that gets you a free coin. So put that coin up at 7. Or put that coin up at 6, move your moon basket to 7. And when this goes to 7, you're going to get $7 for this single retrace right here. So the power really is in ultimately taking your profits from the middle of the market and putting them on either end, maybe alternately putting them on either end, so that once you get to that one or you get to this one, you're going to like 10 times the power of that retrace once you get there. So I hope that explains it. Oh, right. And then there's another concept that I'll mention quickly that I haven't put in here. This is for once you're really living in a market for a long time and you've sort of done put all the money back into a certain peg that you want, and you've built out all your below that you want, and you've built out all your above that you want. You can start doing what we call pillar pegs. And so a pillar peg would be a multi-peg peg. So you wouldn't just sell at every 1, you would sell it like every 4. So at 2, I would set up a pillar that just trades between 2 and 6, or say 2 and 5. So if I get a buy at 2, rather than setting up a sell at 3, I would set up a sell at 5. So that would become a $3 gain instead of a $1 gain off of that retrace. But you don't just have one pillar at 2, you have a pillar and you have your single peg buy. So you're actually buying twice here. You're buying once to set up at 3 and one to set up at 5. And I like to change the number at the end. So if I'm moving by 3, I would buy at $2.03, and that would tell me, oh, that's my $5.03 retrace. But that's being more handled by the software, and maybe not so important that you understand that right in the beginning. But it's nice because then when you have these big jumps in price or big drops in price, you're getting to see a lot more of the profits of the move. And what was I going to say? Okay, yeah. So anyway, so like I said, we have a GPL3 version of this logic working in Python. So we will be creating a newsletter to send out to people that are good with Python or good with just trading in crypto and looking to get into bot trading, but to get in with small amounts of money because we're still working out the bugs. And so like a $50 investment or something like that. We don't need it. It would be you get the software, you know Python enough to run the code on your end. It's your money, your exchange. We don't have anything to do with it. And you understand the risks of trialing alpha software with money. But luckily there's a lot of, anyway. So that's the point. Anyway, I'll wrap this up so that I don't have the camera run out of battery on me again. Anyway, it'll be cool to see what happens in the next week or so as these short positions start affecting the Bitcoin ecosystem. I like to think that Bitcoin is going to destroy the shorts and the short manipulation and hopefully ultimately bankrupt some of these criminal banks and sort of just really wake people up to what's happening. And I think what's happening is a real freedom, financial freedom, and ultimately like a life freedom, that we are going to be free from banks and free of this illusion of scarcity that we live in, and that's being sort of imposed on us by central powers. Once we can trust each other without having to trust each other through these blockchain systems and the apps that get built on blockchain. Once we have like Ubers that aren't centralized, where Ubers are decentralized and banks are decentralized and ultimately governments are decentralized, we could have a sort of a return to Eden, which is the reason that we call the software Eden, because it shouldn't be that hard for everybody to sort of make a living and get by in life. So cool. All right. Signing off. This is Woodybrando's Wild Ride, episode number 2, and I'll talk to you later. Stepping on bowls.